Hi YouTube, welcome back to my channel. I will share with you the valuation of various stocks here with a primary focus in the US stock exchange. If you like my analysis or you have your preferred stocks and want me to analyze for you, please leave your comments below. This is the second episode. In this video, I will go through Peloton Interactive, ticker symbol PTON. Peloton is an exercise equipment and media company based in New York City. Peloton provides two main categories of product. First, stationary bikes, treadmills, and other accessories. As of today, Peloton has sold 5 million equipments. Second, subscription services. Peloton offers consumers a subscription to fitness tutorials, providing professional training courses to users through the display terminal on the equipment. Peloton provides two types of memberships. If you purchase their equipment, you can subscribe to their all-access membership. But of course, you can download and subscribe to Peloton tutorials even you are not an owner of their equipment. Peloton has 2.3 million subscribers to their all-access membership and close to 1 million subscribers to the app membership. 70% of the revenues comes from equipment sales and the remaining 30% from membership subscription. Recently, Peloton's share price has fallen from a high of $162 to around $28, nearly 82% drawdown. I believe that many people see such a decline and feel that the opportunity has come and they want to buy the dip. So today, I will give you an analysis to show why Peloton is still not a stock worth buying. With the improvement of epidemic situation, the demand for Peloton's equipment has declined recently. Peloton decided to temporarily suspend the production of bikes and treadmills in January. This type of news is very worrying. It indicates the long-term growth pressure of the company. Let's take a look at Peloton's latest financial report. In the fourth quarter, revenue is 1.1 billion and the gross profit is 280 million. However, due to the high operating expense, the net loss is 439 million, a year-on-year decrease of 800%. In the past few quarters, Peloton's operating margins and net profit margins was very bad. Most of the time, it is in the situation of making ends meet. That is to say, the company's operating profit cannot cover the operating cost. There are two main reasons. Firstly, the sale of hardware is an asset-heavy operation. The gross profit of this part is relatively low, around 20 to 30%. Secondly, gross profits are not enough to cover the operating costs. In addition, their sales growth is highly driven by advertising and marketing spending. It is hard for them to cut marketing costs if they wish to gain more consumers in future. Due to the impact of inflation, the cost of Peloton has also increased. Peloton has to add a delivery and setup fee to offset the increased material costs. And the additional charge will directly affect the sales volume, which is really a vicious circle situation for Peloton. In the past 6 months, operating cash flow was a loss of 1 billion. We know that when a company loses profits, it is not necessarily a bad situation. It may be entirely a loss due to accounting methods. But a deficit in operating cash flow is really bad for the business. How does Peloton run a company when both income statement and cash flow statement are in the red? The answer is through financing. In the past 6 months, Peloton has raised $1.2 billion from the stock market. Peloton's cash has increased from 1.1 billion to 1.6 billion in the past 6 months. Of course, this is mainly due to the surplus after financing. But even with the current cash position of $1.6 billion, Peloton can only maintain the operation for another 1 to 2 years. Peloton recently announced a senior management change and a major layoff. 1/3 of the workforce was laid off. The CEO has been replaced as well. I guess we don't have to feel too sorry about the former CEO because he has cashed out over 100 million before the share price crashed. This is heavily criticized by the public as well. Senior executives cashed out nearly 500 million before the share price fall. This is really an unethical move for the top executives to take advantage of non-public information to front-run the market. CNBC analyst is suggesting that SEC should step in and investigate. How much will the layoff help Peloton's situation? Let's go back to this quarter's earnings report. Operating costs are around 700 million, with 1/3 of staff being laid off. It will drop to 470 million. This is calculated by simply removing 1/3 of the operating cost. The reduced operating costs is still significantly higher than the gross profit of 280 million. That is to say, the cost cutting cannot solve the problem. It can only slow down the process. Peloton still need to find other ways to make ends meet. Peloton's spending on sales and marketing is around 350 million. As I mentioned earlier, if Peloton were to cut these costs, it will be very difficult for them to keep the current sales volume. In the past 5 years, except for some profits in 2020, Peloton's revenue and cash flow are both in red. The profit in 2020 is mainly due to the fact that users have a lot of prepayments that year. Other than that, all other metrics are pretty bad. Given the current situation of the company, it is doubtful whether it can continue to raise funds in capital markets in the future. Peloton has just got a new CEO, Barry McCarthy, the former CFO of Spotify. I believe what he took over was totally a mess. We will see whether he can turn a profit or not. But personally, I find it quite difficult. While the CFO's background will help him financially, his other experiences at Spotify may not be transferable to Peloton. Spotify's music subscription service has a very high moat. Copyright is the bread and butter of their business. Unparalleled content will make their users sticky. Peloton mainly sells hardware equipment, which is very different from Spotify. Even with their subscription service, there are actually many competitors in this area, and the concept of copyright or IP is very vague. Now let's estimate the value of Peloton. In the beginning, I said that the Peloton's share price is only worth $7. How is this calculated? Peloton is in a loss in both cash flow and the profit, which cannot be used to calculate the valuation. And I'm a bit skeptical to use PE or PS metrics, as it is not meaningful in the current situation. Considering that Peloton's current equity is 2.3 billion and the outstanding shares is about 333 million, so my valuation is actually the book value of their stocks, which is $7 per share. And I think this should be the upper limit of Peloton's current valuation, because as long as the company continues to operate, it will continue to lose money. And in the short term, they haven't found a way to turn losses into profits. That is, the longer the company runs, the greater the losses for shareholders. Whether Peloton can continue to raise money from the market in the next few quarters to ensure the company's operations remains unclear. In summary, there are three main aspects. First, the supply chain issue. The increased material costs has forced Peloton to increase prices, which will deteriorate their already declined sales. Second, the improvement of epidemic has reduced the demand, which is a bigger issue for Peloton compared to the supply chain issue. Third, the moat in fitness industry is relatively low. Transformation is imminent for Peloton now. In short, this is not a company worth investing for now, and holding its shares will only damage the interests of shareholders. Alright, that's all for this episode. If you like my video, please like, subscribe and share. If you have good suggestions and recommendations, please leave your comments below. Thanks very much again. I will see you in the next episode. Bye bye.